Thank you very much. Good morning, everyone, and welcome, at least virtually, to the 2020 Intercom Conference. As you said, I'm Scott Reese with Netherland Sewell. We're proud to have been a sponsor of Intercom, the conference, since the 90s, so over 20 years. I'm not sure all 25 years, but 23 or 24 years. We're also very proud to introduce our next presenting speaker, our company, Comstock Resources. Comstock is Frisco, or kind of North Dallas-based company focused on the Haynesville gas play in North Louisiana and in East Texas. If you follow Comstock over the last year or so, you've probably noticed them in the news. Even if you haven't followed, you've probably noticed them in the news. One, for the big acquisition they made of Covey Park, a private operator in the Haynesville last year, about $2 billion. And second, because Jerry Jones, owner of the Dallas Cowboys, is a prominent investor in the company. And lastly, because kind of they've continued to stay active in the Haynesville Shale, even as you've seen rig counts drop all across the United States. Here to present the Comstock story is the Comstock management team: Jay Allison, Chairman and CEO, Roland Burns, President and CFO, and Ron Mills, VP of Finance and IR. So I'll turn it over to you, Jay.
I'd like to make two comments. First, we're always thankful to be able to present at Intercom, and this is the 25th conference, so we're thankful. And then the other thing is Fred Sewell, the Netherlands Sewell, the Fred Sewell, he was one of our board members up until about 2 years ago. So the reason we had him and other quality board members is he could, from the audit committee side, he could check the reserves and just another checkbox. We always go with a checkbox. Like on Friday, we wanted to have more liquidity, so we issued another $300 million of bonds to add to what we have now is about $900 million liquidity, and that was one of our checkboxes. So again, I want to say hats off to you and the Netherlands Sewell Group. We've trusted you for a long, long time. So with that, I'll start. We have been very active. I know this COVID-19 has set everybody back on their heels, everybody, period. We have been active during this time frame. In April, as you know, we issued $200 million of equity, and in May of this year, we issued $500 million of bonds, and then last Friday, we issued another $300 million of bonds. So we have been active. We've been leaning forward, and as you said, we're doing this all in the Haynesville Bossier. We're kind of at the post position for low cost and high margins, and that's where you want to be. So we want to try to stay there. If you'll, if the audience will look at slide 3, we'll go over this. We try to do things in a very simple format, and we just say, well, why would you spend, the time that God gives you looking at Comstock? Why look at Comstock? Why invest in Comstock? And we give that. We think we've developed industry-leading margins. We are, as far as return on capital, we're the top tier. Even in this challenging environment, we're top tier. We're well positioned to benefit from increasing natural gas prices. We're 98% natural gas, 2% oil. If you look at our 2020-2021 operating budget, we really are focused on free cash flow generation and delevering. We intentionally look at that. We look at our free cash flow, and then we kind of backwardated what our CapEx budget might be to have a 5+% growth. We are in the premier natural gas basin, in our opinion. That's because our geographic proximity to the Gulf Coast, and we have attractive marketing opportunities. If you look at inventory, the depth of inventory on slide 3, we have over 2,000 high return drilling locations, and we drill 40, 50 plus of those per year net. So we've got great inventory for future growth at very attractive returns that are proven because of our historic performance. We're low cost structure, which I mentioned earlier, high returns, and that creates our unparalleled free cash flow generation, which we've had. And as you had mentioned, our majority stockholder, Jerry Jones, who owns a little over 60% of the company right now, he's invested a little over $1 billion since 2 years ago. In fact, we closed a transaction with him August the 14th of 2018. So he's got about $1 billion plus in the company. He's as enthusiastic today as he has ever been on his position in Comstock and the value of natural gas, period, in the energy sector. So those are simple reasons on 3. If you'll go to 4, we'll kind of give you an overview. Most of you probably have seen this page before. We just kind of refine it every time we visit with people. But we are the leading Haynesville operator, and that transition happened really when we closed Covey Park. Covey was about $2.2 billion purchase that we closed July of last year. So when you see these numbers, those are consolidated with the Covey transaction. We now have look at the top right-hand side of slide 4, we have over 305,000 net acres, and that's in the blue area on slide 4. That's where our 2,000 drilling locations are, and we've drilled on all 4 corners of our footprint in the blue. The green line on that map at the top right, that delineates where our Haynesville shale is. And then the black line, which is kind of toward the bottom of that map, shows you where the Bossier shale is productive. Now, the Bossier is probably 600 feet above the Haynesville. And then we give you some company statistics at the bottom right. We have enterprise value of about $4.3 billion, market cap about $1.4 billion. We produce anywhere from 1.3 plus BCF per day in the second quarter. We have 5.4 TCFE approved reserves. Again, there's 98% natural gas. Got a PV10 value of $3.3 billion. You keep looking at 4. We have industry leading margins. You look on the left-hand side of page 4, which were 69% in the second quarter. We expect to generate about $100 million of free cash flow in 2020 and over $200 million in 2021. Again, our location near the Gulf Coast gives us favorable gas marketing opportunities, which we highlight on page 4, and that's because we're close to the Henry Hub, which limits our basis risk, and we have attractive gathering contracts with no unmet minimum volume commitments. That can be a burden. If you flip over to 5, on page 5, we recap the equity and senior notes offering that I mentioned earlier that we completed in the second quarter. In May, we did issue 41,325,000 shares and an underwritten equity offering, which is priced at $5. We use the proceeds to redeem a $210 million Series A convertible preferred stock at face value, which is part of the Covey transaction. And then the redemption saved us about $21 million per year by eliminating the 10% dividend that we were paying on that Series A. Then in April and May, we did exchange 2 different transactions, $5.6 million of our 7.5% senior notes due in 2025 with certain holders for newly issued stock and Comstock. Then in June, we were active. We used proceeds from a $500 million senior note offering to pay about $441 million of borrowings under our borrowing base. And then Friday, several days ago, we sold an additional $300 million of senior notes as an add-on to our June offering. So the senior notes offering, if you combine the 2 of them, it substantially improved our financial liquidity, which increased from $150 million to now over $900 million, which again is a check-the-box event for us. If you flip over to slide 6, we have 5 boxes, and we say you have to do all 5 of these in order to be successful. You can't let one of them drop out. But it's our corporate strategy. If you look at the top, we have proven that we have, and we commit that we will continue to develop our high quality inventory that grows free cash flow, production, and reserves. We continue to enhance return on capital by focusing and optimizing our already low cost structure, which is this enhance a block. We're going to do that by reducing drilling costs, which we've done. We've got a slide on that. We're going to continue to pursue strategic acquisitions. I know in all of our calls they ask about M&A, and we said, well, if there's something out there that keeps our low cost structure, that has tier 1 locations, that keeps our high margins, that makes us a better company, that delevers us, then we'll look at that. But we do have, we look all the time, but it has to complement our high quality assets, like the Covey Park transaction that was mentioned earlier. And then we continue to have financial discipline and manage our balance sheet. You can see that on 6, and continue to manage our commodity price exposure through a very attractive hedging program. We've got about 50% of our gas hedged in 2020 and a little over 60% hedged in 2021. But all 5 of those are very important. If you limp around on one of them, you'll get in trouble. So that's one of the reasons Jerry Jones has continued to back us because we're very consistent on that. If you look at seven is an unusual slide because we may be the first, if not near the first, to say, why the Haynesville versus Appalachia? I mean, why? I mean, Appalachia is 32, 33 Bs plus a day. Haynesville is about 10 Bs or so. So why the two? And I think that's one of the reasons we kind of said we're public. We've been public for probably 3 decades. We're really exclusively Haynesville. And why is that a good thing? Why do we give you a choice, whether you're an oil company or a gas company? Why do we give you a choice to come here to the Haynesville? Well, we show that we compare the two basins, and Comstock and the Haynesville are highlighted in red. So if you see red, that's Comstock, and the blue is Appalachian. If you look on the far left-hand side, it really all starts with the location advantage the Haynesville has, which is demonstrated by the Perryville Hub, which is a major Haynesville hub where natural gas traded at 19 cents less than Henry Hub in the second quarter versus Dominion South, which is a major hub for the Appalachian, which traded at a 36 cents less, and it's much more volatile. So it starts out with favorable differentials, but the lower differentials are just part of the story. If you look in the lower midstream costs, you'll see that our gathering and transportation cost to get to market is 22 cents versus the average of $1.05 for the Appalachian companies. So if you look at this superior full cycle economics, I mean, our full cycle economics are superior, shown by our EBITDAX margins divided by our 3-year finding cost, which is 3.6 times versus the 3.1 times for Appalachian, which we show on that chart. We have a really great deep inventory, almost 60 years versus Appalachian of a little over 16 years. And then the higher IRRs, I mean, based on a third-party type curve, which is RS Energy, the Haynesville wells have a faster payback. We get our money back in about 1.5 years and a higher IRR. We show that at 55% versus the Appalachian at 2.5 years as an average payback and 34% IRR. So all those things, they differentiate the Haynesville from the Appalachian. And I think the bottom, we have ample room to grow. If we need to grow, we can. If the profits are there, we can. We have room with the midstream pipeline to grow, and I don't think we have the same touch points that Appalachian has. So I think that's one of the reasons that Jerry Jones has the $1+ billion into the company. He saw this. Slide 8. It's just, where's your future? Do you have to buy something to be able to drill? And the answer is we don't. On slide 8, we show our extensive inventory of high return drilling prospects. And again, Netherland Sewell audits all this stuff for us. We have over 2,000 net locations with over 74% having long laterals. We operate 1,849 of those net locations. So it's a real solid inventory. And in fact, we had a little over 800 locations at Comstock when we bought Covey. We got another 1,200 or so. That's why we've ended up with this high inventory chart. If you go to 9, on slide 9, you always have to continue to improve results and lower cost if possible. So you can see beginning, I mean, our completed cost per lateral foot was $1,500. And today we reported just 2 weeks ago, Thursday, that they're $1,028. So you see they're coming down, particularly in 2020. And we do have new service, lower cost for new service contracts for completions. We've just started completion rigs back a month or so ago. So we have a goal that we're trying to get these completion costs, drilling completion costs, to $950 per foot. I think we have a chance to do that. And then if you look on 10, it's just an overview, and everybody has their own opinion on what the market will do for both oil and gas. We give this as a gas chart on 10. And we just look at the fact versus fiction. The fact is drilling and completion activity in North America has decreased significantly. That's fact. That's not fiction. The rig count is down more than 65%. That's a fact since March. Completion activity is down over 70%. And capital expenditures are down over 40%. And it looks like Wall Street's going to make everybody control the capital and have a return for the shareholders. If they continue that discipline toward the E&P companies, I think that it's very favorable for Comstock because of our cost structure and our inventory. We look at the oil producers slashing activity and shutting in wells. We show that on 10. And so associated gas is expected to fall sharply with that. It has, in fact, fallen. We think natural gas production will fall about 8 BCF or so, which it has already this year, and it'll fall a little bit more next year. Now, there will be some demand destruction. We understand that. It's expected for natural gas, but, you know, since natural gas is not used much as transportation fuel like oil, we believe that the lower supply will exceed any reduction to demand. So natural gas futures have improved for 2021. You look at the slides, and many Wall Street colleagues along with us, we expect healthy supply-demand balance next year. We're already seeing that. So we're very favorable, but we do risk adjust our numbers by an aggressive hedge book. So Roland, you want to take it over on 11?
Sure, thanks, Jay. Yeah, one of our key advantages is our location, which we kind of show on slide 11. The Haynesville Shale and our acreage, which is shown on blue on this slide, is situated right above the Gulf Coast, which is natural gas's fastest growing market driven by industrial and LNG export activity. Historically, most of the natural gas from the basin flows either to Carthage on the Texas side or Perryville on the Louisiana side to connect to major pipelines and markets. 60% of our gas flows to Perryville, which currently has a low differential to Henry Hub, and 40% of our gas is directly tied to Henry Hub or other premium Gulf Coast indexes. We have minimum volume commitments, less than 200 million a day, and we don't have above market midstream obligations. It's one of the major secrets to our low cost structure. We're an anchor shipper on Enterprise's Acadian line, where we now sell our gas at Henry Hub minus 11 cents. And on completion of their expansion, which is expected in late 2021, we'll have 1 BCF a day of first priority on Acadian, and that will allow us to increase our percentage of natural gas tied directly to Henry Hub closer to the 60%. Until then, we're using medium-term sales agreements with end users to lock in our basis differential at Perryville. And this is one of our favorite slides at Comstock. This slide shows our best-in-class cost structure, which drove our industry-leading EBITDAX margin in the second quarter. And we compare ourselves to gas peers on the top, and then we also compare ourselves to the gas peers and some of the stronger Permian companies. The operating cost structure that we have is one of the lowest in the industry, and it's much lower than the other major natural gas producers. Our second quarter combined producing cost and corporate G&A was 59 cents per MCFE, and that's 30% lower than the next gas peer. You can see our major advantage is the lower gathering and transportation cost of 22 cents versus substantially higher numbers with all the gas peers. Our second quarter unhedged margin was 61%. That's higher than all of our gas peers and higher than our oil-weighted Permian peers. If you count our hedges, our margin was at 69%. And you can see that in the price challenge second quarter, this really stress tests the company and show how the cost structure stood up to the very low prices. We still generated an attractive margin in one of the weakest price quarters that the industry has seen. Our high margins and our low cost structure allow us to deliver top tier financial returns, which we kind of show on slide 13. Our advantage is driven by the higher price gas realizations, given our access to the favorable Gulf Coast markets. We have the lowest midstream rates in our basin and in the probably natural gas industry. We have a very efficient corporate overhead structure with only around 200 employees and a high production base. And our Haynesville gas is high quality and overpressured, so we don't have significant cost to either treat our gas or for compression. We also have very good scale in the Haynesville as the basin's largest producer. You can see from the charts on the right that our 2019 EBITDAX margin was almost 80%, and that's in the top quartile of all E&P companies. And our 2019 return on capital employed was 9.1%, also a top quartile number. Slide 14 recaps our current capitalization after Friday's notes offering. We had $2.8 billion of debt outstanding, including $800 million outstanding under our bank facility at the end of the second quarter. Our borrowing base under the bank facility is $1.4 billion, and we're using our free cash flow that we're generating to reduce our outstanding borrowings for the rest of this year and into next year. The borrowing base will stay the same after the issuance of the new notes that we sold on Friday. We have no maturities until 2024 when the bank facility matures, and our senior notes mature in 2025 and 2026. We retired our Series A preferred, leaving $175 million of preferred, which is held by our majority stockholder. And with the notes offering that will close later this week, we'll reduce our bank debt to about $504 million on a pro forma basis, which will increase our financial liquidity to more than $900 million. On slide 15, we kind of highlight the improving credit profile of the company. Since 2018, we've taken major steps to improve our balance sheet and credit profile. It all started with the acquisition of Covey Park last July. The scale we gained from that combination established Comstock as the Haynesville Shale's basin leader with the industry's best cost structure and margins. Post the Covey Park merger, we've implemented a sustainable, conservative operating plan. We prioritized free cash flow generation over absolute production growth. Even with the low oil and gas prices, we're on target to generate approximately $100 million of free cash flow this year, and we'll target generating over $200 million for next year. We have one of the industry's lowest cost structures, and we're generating top quartile returns on capital employed. We're protecting our business model with a very prudent hedging program. We're over 50% hedged this year and over 60% hedged for 2021. Our May equity offering allowed us to retire the $210 million of preferred stock, which allowed us to reduce our annual fixed charges by $21 million. Our March borrowing base redetermination for our bank facility went fairly well, with only a 7% reduction as compared to industry-wide reductions ranging from 20 to 40%. The bank price forecast used for natural gas was at its lowest point for that redetermination, and many of our larger banks now have increased their natural gas price forecast by anywhere from 15 to 30 cents since last March. We have an attractive maturity schedule with no senior notes due until 2025 and 2026. And then our June bond offering grew our financial liquidity over $600 million, and our recent add-on offering will augment our financial liquidity to over $900 million, as well as it allowed us to achieve our goal of reducing our borrowings to under 50% of the borrowing base. The free cash flow will also push us further toward our goal of reducing our leverage to less than 2 times. We think we get there organically by 2023. So we'll use the rest of the time for our presentation to take any questions. I guess we'll turn it back over to Scott to see if he has any for us.
Hey, good job. Thank you, gentlemen. This is Aaron over at Entercom, and I appreciate you guys being here and taking the time. We do have a number of questions. I did want to start out with the first one here is asking about your 2,000 future drilling locations, and is that adjusted to take into account anticipated lease expiry that may happen across your acreage?
Yeah, that's a good question. I mean, I think that we have, almost substantially all of our acreage is held by production, and the
95% is HBP.
And what's not, we really do plan to develop in order to hold that acreage. So we believe that the location count reflects all the locations that we will have access to.
Yeah, and you look at, we've had as many as a 9-rig program. In 2019, we dropped that down to 5. We look right now, we have 5 rigs. We probably in 2020, and you look at the location count, it's probably a 6-rig program. We can toggle it up or down, but when we look at our locations, I mean, we have plenty of rigs committed to drill to hold any locations that we might lose. And again, one of the great strengths we have is 95% of everything we own is HBP. So, and the other thing is we haven't densely drilled these wells in just one parish or one county. We've drilled on all four corners, north, south, east, west. So we think we've de-risked those locations, or we wouldn't have them in there.
And thank you for that. So here's another one. So over the past year, your well costs have decreased significantly. Maybe you can speak a little bit to the primary drivers to that well cost reduction, and what changes did you make to your design as you went through there?
You know, most of that cost reduction is not the drilling costs. They've come down a little bit. But, you know, materially, it's the frac cost. I mean, our stages used to be $80,000+ a stage. Now they're maybe $26,000 a stage. Most of that is in frac cost savings. And again, our stages are different. Our clusters are different. We do tweak that all the time, but it's a savings in the frac. And we use, you know, 2 or 3 different frac companies, so it's not in isolation of one frac company giving you a discount.
And so here's another one that changing a little bit out of the nuts and bolts, but given your leasehold and size and future production potential, particularly out of the Haynesville, how do you guys look at the LNG outlet and your proximity to that Gulf Coast market to be able to sell LNG, and what does that look like for you guys?
Well, one of the reasons that Jerry Jones invested, I mean, he put his finger on a map. He liked the exports to Mexico. He liked, you know, the power demand, industrial demand. It was probably 40 BCF of power demand, 22 of industrial. You look at the 5 or 6 BCF to Mexico. But I think the game changer was LNG. So the proximity to the LNG takeaway facilities was a key. And the fact that we were close to Henry Hub. So, you know, when he first invested, I mean, LNG, you started exporting it in 2016. You know, went to 9.5 BCF a day. It dropped down to about 3.3. We're at 4 and change. But I think if you look at the reason the LNG facilities are continuing to be built, and the value is that we have the cheapest gas probably in the world right here, and the safest gas in the U.S. And we're geographically right on top of that. So we think it'll grow. We do think it's swing gas. If you look at the gas produced, I mean, 92, 3, 4% is used domestically. Only 6, 7, 8%, you know, do you export? So I do think that's a swing number. I think it's favorable to us. So.
But one of the things we're excited about being the anchor on the Acadian line, their extension, is that we'll have a direct outlet to Gillis, which will be the hub that the LNG guys are looking to have their gas delivered to. So I think we'll have much more access to delivering directly to them. We already are doing some direct sales to Cheniere, you know, really delivering the gas at Perryville, and they transport the rest of the way. So I think that is a good market for us, and we'll be able to efficiently access it, especially toward the end of 2021.
The other thing, you know, we said in the second quarter, we're producing about 1.3 Bs a day. We market about 2 Bs a day. And I think we have more uncommitted gas that we produce than any other E&P company out there. So if you're midstream, and we've got a good balance sheet, and we've got good liquidity, and we've been active, and we've got a great sponsor, you know, above all of our other sponsors, which is the equity and bond holders and our banks. You know, you want to do business with an E&P company that's leaning forward, that's stable, that has a lot of undedicated gas, because quite frankly, if you're midstream, you want that gas.
And so our next question goes into that leaning forward. So if natural gas prices in 2021 go higher, and maybe even firms into 2022, can you give folks a little bit of color into your strategic options and the way that you allocate capital and take advantage of some of those outlooks, and where are you going to be putting money to work if that's the case?
I think the whole industry has to be disciplined in capital. I think you see the majors doing that already. I mean, they're committed to have X% growth, and then they're going to dividend back the extra cash to their stakeholders. I think that the balance sheets have to be cleaned up. I mean, our cost of capital needs to be cleaned up. I mean, I think that's one of the things that the next box we need to check. Our cost of capital is too high. So we need to continue to pay down our RBL. We need to continue to help our leverage ratios be stronger. And I think if you'll see us aggressively hedge, we need to hedge. We need to have a couple plus $100 million of free cash flow. You won't see us materially changing our rig count, I don't think, just because price went up. Now, we may toggle it a rig or two. We may, but we can do that and still have material free cash flow. But we're all about being disciplined. I think that's why the equity market accepted our equity in May, and I think that's why we were able to raise $800 million of bonds. And our second bonds were priced at a discount to the first bond. So if we don't continue to prove that, then I think we'll lose part of the reason that the market likes us.
Or priced at a premium to the last bonds.
Yeah, and congratulations, by the way, on getting that done. So to take that one step further, to stay on this idea of the balance sheet, you certainly have been active in the capital markets. How do you think about that, and how has that changed your liquidity position, maybe just to hear in the near term? And then how do you get that to translate into maybe your multiple, or is there still an effect on some of that capital on where you guys are trading today?
Well, the second quarter was kind of it was a difficult quarter for all E&P companies, period. And, we did ink out about 1.7 million of profits. We didn't have any impairments. I mean, just think of the impairments that were taken in the second quarter. We didn't have any impairments. We I think ended up with probably more locations than we started with at the beginning of the year. We farmed up our drilling commitment and showed you what we do in 2021. So I think the market, the S&P used to be 15% E&P, and now it's 2 or 3%. I think the market is saying, guys, you got to prove that I can give you capital. I'll give you an expanded multiple. So I think where we are, I think they believe that we'll honor our word, and we have the inventory and the people to do that. But I still think they need to see it a little longer. And then if we continue to perform like we did in May, June, August, I think we'll get that expanded multiple. If you look at the new research coverage that we had when people were kind of hiding and didn't have to initiate coverage on companies, we probably have 4 or 5 new research analysts come out and say, hey, here's a buy, here's a hold, but at least they become active in the name, which we needed that. And they didn't have to. It's easier not to do anything. But they came out and at least voiced an opinion on the company. That's a good thing.
Well, gentlemen, I thank you very much for your time. We'll leave that as the